Hello everyone, it's the Cowboy. Welcome to the Macro Cafe episode 14. This is Saturday morning here in Chicago at about 10:30, and let's jump onto our macro outlook. We do these episodes every couple of weeks. We've missed the last one because I was on a summer vacation, but let's take a look at the Bitcoin. We'll take a look at gold and oil, the SP500 dollar yield, and kind of see where the whole macro field is in, and kind of what's to expect here for, let's say for the next few months. And at least as far as we can look up into the future and see what the markets are telling us. Guys, it's very easy to find me. I'm on Telegram at Elliott Wave Cafe. There's a public chat, a premium room, also on Twitter at Elliott Cafe. So I'm not going to spend a lot of time here. Let's just continue to go and jump straight on to Bitcoin. Bitcoin, it's been acting very, very weak. And with all this weakness, it continues to hold these 31,500 levels. It's been consolidating here since that larger sell-off that we had in May 19, so a few months back already, and we still haven't been able to make new lows or massively new lows and break to the downside. So if you know a little bit, if you want to know a little bit more information about the counts, you can check my video from from last week actually, where we're looking at the wave structures in Bitcoin and kind of thinking of how high it's going to go before it actually starts to sell off again. And I'm thinking this is possibly a 5-wave completion to the downside. I'm looking at this as a W, possible super complex move here in this X wave, followed by a rise, maybe back towards 40,000, maybe even 45 before we sell off again. If the structure here proves to be complete as an impulsive pattern. Now, if we're breaking straight lower from here, then I have to look at it as a larger second wave where this becomes, let's say, an ABC for the W. This whole thing here is some sort of an X wave, and then we're declining lower and trying to finish that move towards $20,000. So we are below the 50-day moving average. We are below the 200-day. The volume is kind of declining in here as we're obviously moving sideways. But I think even if we're going to sell off and do a little bit of a sharp break of these levels, I think there's going to be a sharp rally coming up. And that's going to kind of create that either B wave or the wave one of a larger advance. Up here onto the weekly charts, these are you can see we've broken below this pretty important trend line right from March of last year, and we are continuing to rest on this 50-week moving average. This continues to provide support longer term. It's an important barometer here, but I cannot stress the fact that we actually broke below this trend line, and the price section here remains weak. So Bitcoin has to prove itself and try to kind of regain above the 20-week moving average, get above that trend line to reinitiate a little bit more of the bullish sentiment. Otherwise, we could still continue to be in a larger correction. And again, I'm not looking at this as a fourth wave. I think it's not really matching with anything we've had so far. So I'm looking at this as a wave one of a larger advance here, and the initial phases, or the half phase of a second wave decline. So something like this, where we're either going to bounce, or continue to push lower in the second wave, something like that. So that's what it is. Go ahead and take a look at the Bitcoin counts from last week, and you'll see a little bit more what I'm thinking there. Now let's jump over to take a look at oil and overall the macro field and see what's going on. I'm thinking we're going to get into a period of a little bit of a weakness in oil. I think the trade has gotten super crowded. We've been kind of been all over it since these kind of $40 levels, looking for the 71 and 76, this previous highs from back in 2019, 2018, and those levels held pretty nicely, and now oil is kind of selling off slightly. You can see this is a massive channel that started back in 2008. And we're kind of hitting prices right against that trend line. So I would expect, even if you're going to try to make maybe a marginal new high in here in the price of oil, I still think that we're probably going to try to push back and just try to get some kind of a ABC correction in here before, let's say, the larger advance here starts in this I would call it maybe a C wave. Remember, this was a big flush down in oil back in March, and it kind of terminated this lackluster performance of oil since 2008. So this pretty massive deflationary period that we've had. So now with the reopening of the economy, we're looking for inflation to continue to push higher, and this should be reflected in the price of oil, pending a little bit of a sell-off, to kind of try to reinitiate the trade to the upside. So this will become a massive neckline. This will be a left shoulder. This will be some kind of a right shoulder, and then we're going to continue to push higher. So I'm cautious on oil. I got dry powder to re-enter the energy trade as soon as we're going to get a better opportunity on there. You can see here that on the daily charts, for example, you are getting just a very simple three-wave setback, which tells me that there could be another push higher before we're actually kind of correcting a little bit lower in oil. And, right now we're still above this 50-day moving average. The 20 days is back at about 56. I don't think that's going to get tagged. This should be a massive support on the downside. So even if we're going to push higher again, I'm expecting a little bit of a sell-off next. But we are still in the summer. Maybe this will continue to kind of grind lower to the downside, for a few weeks down the road. So that's my view in oil. Now let's jump over and take a look at gold, which has been rallying nicely. This is the kind of the longer picture that I have on gold, where I continue to look for these prices to move higher above this $2,000 level, the all-time highs that we've actually had in the summer of the last year. And we've been correcting ever since. Gold hasn't been a very, very good performer, but in terms of its counting, I'm thinking that we're still got to do a fifth wave to the upside to complete this larger third, followed by a fourth, and then fifth to complete a larger wave one. Now, as you very well know, gold is, very, very tied to some of this inflation expectation and to the real yields. And, it's not as easy of a trade as it seems. You're saying, hey, inflation is going higher and gold should rally. I still think we still got to fight this, 1900 to 1959 level before we actually continue to break higher. So for right now, we've been correcting. Let me see if I can find the chart here on a smaller time frame. I don't think I have it. But it's basically what I'm looking for is this as a wave decline followed by a wave B to the upside, and possibly another little bit of a sell-off in here to complete a second wave and then push back up higher. So I'm looking for gold to kind of be stable a little bit sideways, maybe with a little bit more corrective pattern before actually starts to rally much, much higher, maybe starting in September or something like that. But overall, I continue to be a holder of gold miners, GDX, and I have a pretty good exposure, and I want to be protected. As you can see, the inflation numbers here continue to rise, so I think it's important to have gold in the portfolio. I wouldn't have my expectations too high at this moment. You can see back in here, if you want to study the correlationships, what's happening in the gold market, take a look at the TIPS market. So these are inflation protected bonds. Basically, the government pays you if the inflation continues to rise. They pay you twice a year, so tips should be an important part of anybody's portfolio there, just to kind of get protected against inflation. But if you get a deflationary period, you're going to lose and you're going to get less money on their interest. So as you can see there, the gold prices kind of continues to follow this tips bond pretty much tick to tick, and we're having a little bit of a disconnect lately, which tells me that either that the inflation story, it's a little bit pushed, or that gold needs to start rallying fairly soon. So if this is a wave one of the lows, maybe we're going to get a slight more dip, or maybe not, and then push to the upside here and kind of catch up to the tips. So pay attention to this chart, because it's an important kind of indicator in terms of correlations. The other one, it's obviously the inverted relationship with the real yields, which are measured by subtracting the 10-year break-even inflation from the 10-year yields, and they are getting into a deeper negative territory. We're coming back here into support. As you can see, they're selling off in here. Gold is trying to rally, but it's not following through just yet. So there's a lag here that's going on, and if this continues to break to the downside, I think that's going to be a trigger where gold would actually push much higher and try to get towards that $2,000 mark again. Here is another relationship that's also easy to follow when you look at gold, And what you have here in black, you have the 10-year yields, which are kind of pushing back towards 130. I'm going to talk about those in a second here. They've been rallying, since July last year. So very, very strong rise in the 10-year yields here, from 50 basis points to almost 170, which, was followed kind of by a sell-off in gold. And now as the yields kind of push back in here, you can see how gold is actually starting to rally. So it's a little bit of a, it's quite a good inverse relationship between a sell-off in yields and the rise in the prices of gold, which tells you that, the more the yields go towards negative territory, the more gold becomes attractive to hold in somebody's portfolio. If the government is going to pay you, a nice interest for buying their, bonds, there's no real point in kind of holding gold, because gold has no interest. But if you're going to get negative, then gold is more attractive. So that's kind of the idea behind gold and yields. Guys, don't forget to subscribe and like to this channel. I mean, we're doing a bunch of videos every single week, and from crypto to obviously macro, and it's important that we continue to rise in this country. So don't forget to subscribe and like, and I appreciate you being here. All right, let's jump over and take a look at the larger picture on yields, and we're looking a little bit at starting with with the higher government bonds there, where you start from the 30-year and come back to 20 to 10. So you can see that what's been happening lately, since I say end of March, maybe beginning of April, we started to have a decline in the longer term yields in here on the 30, the 20, and the 10, as we're kind of moving lower. So almost looks like a correction in yields. In the meantime, what's going on, you have a stabilizing move here into the 5 years, and then also into the 2 years. So the shorter term yields are starting to become more attractive versus the longer term yields, which puts pressure on the equity markets, right? This is what you don't want to see when the investors thinking that the growth in the economy is going to slow down, or that kind of the recovery process got in ahead of itself a little bit in here. So this is a message that I'm having, from what I'm seeing at the yields here, right? The longer term bonds are pushing back. The longer term yields are pushing back, while the shorter term are stabilizing or rising. And then you get that inversion into the yield curve, which pretty much tells you that, there's a little bit of a stress on the horizon. We are in a period of transition in here. So for a continuation in growth, what you actually want to see, you wanted to see the 30-year continue to push higher, the 10-year push higher, and then these kind of stay stable or kind of follow through, but at a smaller rate. So you're looking at for that kind of yield curve to continue to push higher. So let's take a look here on what I have. And this is a very interesting chart, because what it shows basically the spread between the high yield corporate bonds, which is HYG here, and TLT. So that's the spread, which I have it in this kind of dotted line, and you can see that ever since March, right? So just a very similar story with the yields. Every time that this line kind of moves down, people prefer government bonds, 10 and 20 years and 30 years bonds, versus more riskier bonds, which are the high yield corporates. Right, so as the market rallies in here, you're getting more of a ratio towards risk, and as as this ratio kind of moves up here, you're probably going to get a little bit of a sell-off into the stock market. So this kind of tells you that investors starts to be cautious here towards the middle of the year. Now the SP 500 hasn't really responded yet. We've gotten a little bit of cracks under the ice here for the past week or so. I know we're coming into a period of earnings, so it's interesting what's going to happen if this ratio is going to continue to push, and with the S&P 500, or the S&P 500 will start to kind of melt down. What I've done here into the pink line, I'm also showing you the Bitcoin chart, which it looks very interesting. It's a very, very kind of tight correlation with the risk market, right? So it's a very, very good proxy for risk as people deleverage and start to have a little bit of a lack of confidence into the risk going forward, right? People are kind of getting to safety, getting into the cash. You see a little bit of a rise into the dollar in here. And I'm not sure if this is just a transitory period, just a small blip, and we're going to continue to push higher, or if this is going to extend a little bit longer before the new advance starts. So I guess what's going on is people really want to wait and see how strong the economy comes out of this recession, what the Federal Reserve is going to do, how long it's going to be before they're actually going to start to pull back their asset purchases, when they're going to start raising interest rates. I think it's a little bit of a period of wait and see, and people prefer to kind of jump on to the safety wagon rather than on the risk wagon. And this is pretty much clearly also in Bitcoin, along with some of the other assets. So it's interesting to continue to watch this relationship between between Bitcoin and between the spread between corporate bonds and treasury bonds. The next one that I have in here, guys, it's we're jumping over and taking a look at the dollar, which has been pretty bullish here since I don't know when it was, probably back in, again, it's kind of same in May, end of June, when it kind of hit this low. It tried to rally before, back in March, March and April, when we said, I don't think this is going to get too much leg to the upside as we're kind of hitting the 200-day moving average. We've gotten a sell-off. I was looking at this as possibly a fifth wave to the downside to kind of take off these lows. It never really happened. You could look at it as being a truncated fifth possibly from this whole move back in here. And now you're starting to get a little bit of a correction. Now, these levels are important. If you're going to kind of get above those levels, I'm still going to look at it as being a three-wave advance from this low in a possibly, let's say that's a W, and then you're getting an X, and then you're getting a Y wave to the upside, followed by a bigger sell-off. Because the dollar really has to prove itself. It's been very, very weak since March of last year after it had that big spike. And, with all the government money printing and the Federal Reserve being where it's at, I think it's in a structural, decline. And if the economy weakens, the Fed is probably gonna come back and press some more on the gas pedals, or we're gonna get more stimulus checks or whatever. But I don't think the United States economy has enough strength to necessarily sustain, or actually the level of debt that it has enough strength to support higher dollar prices ahead. So let's kind of continue to watch. At the bottom here is the euro dollar, which is kind of coming back near 118. These are important levels as well, but I'm looking at this whole thing as being a second wave before a much, much bigger rally starts in the euro and weakness in the dollar. So take a look here at a little bit of the count. It's just kind of what I've explained a little bit earlier. If this is a wave one of the lows, then you're looking at this as being an A, possibly a B, and then push back up higher in this second wave. C, that's an important level of resistance back in here at about 95. I don't think it's going to get a lot of strength to get above those levels, and then look for a sell-off. But this whole thing could be, if you're finished back in here, and this move is all we're getting is a correction, right? And that's the decline. Because counting this decline here, it's a little bit messy, so I would not be surprised if this whole thing is an ABC, and then you're selling lower. But remains to be seen. I think there's still a little bit more pain to go through into the dollar trade before we get more direction on there. Take a look at the euro as well, because this looks a little bit better in terms of its kind of structure on the charts, and this is looking back to 2008. So ever since the euro hit those 160 levels, it's becoming down, and back in 2017 it hit those lows near almost parity back in here. This base held pretty well. Then you had a nice 5-wave advance followed by a correction here into the 78.6, and now again you're getting an impulse out of here. And I think this is just like on the dollar index. Either this is the whole second wave, or you're going to push a little bit lower, retest this trend line pretty well before the major rally starts, let's say by 2022, 2023, and the dollar will really get hit. So now let's jump over and take a look at the SP 500. It's it's a very interesting market. Definitely, it's been doubling since these levels. So we've been at 2,200, now we're back at 4,400. So almost 100% rise into the equities since the March 2020 lows back in here. Now, you can look at this count and say, yeah, it's possible that it's a fifth wave if you're counting this as a larger fourth wave. And then this whole thing being a fifth wave at this degree of trend. You're looking at this, kind of super cycle degree. And then, you're, obviously you would expect a big sell-off. Now, just because we can count 5 waves in here, it doesn't mean that we have them. You would need to have confirmation from the price, and fighting such a long, rise into the equities and such a strong trend, it can be very, very painful. So, before I would short this market, or before I would, let's say, step away from it or sell all my stocks, I would definitely wait for some kind of a signal from the market, that it's from the price, that is actually, it's starting to weaken. And, for that, you would need to kind of start to see a little bit of a pullback back in here for some kind of a three-wave advance, following the decline, then a little bit more back here towards 32. I don't think this is going to happen in a vacuum like it happened last year. It's probably going to take a little bit of while to, and it's going to be bigger volatility here, maybe coming into September, October, who knows, before this market kind of starts to correct a little bit more. So, the last thing you want to do is you want to miss the upside. So I would want to stay involved into the stocks here, maybe raise a little bit of cash. But what if this whole move here is just a wave 1 back in here, and this is a major flat in a second wave, and you're actually much ready to push to the upside? And this is how that ultra bullish count will kind of look like, where you're, instead of this being, a 4th wave, this is actually a 2nd. And, you're just beginning the larger advance, and you're moving towards, let's say, 10,000 S&P over the next, 5, 6, 10 years, right? You can almost just continue to double from here. So, it's hard to find a market that's bullish, and there is nothing more bullish than a market that makes new all-time highs. Now, I know we could be in a period of just kind of, again, transitioning from the reopening of the economy to the stabilizing, and, we need to see how much labor we have available. There are signs everywhere of people hiring. We got to see how, if the Democrats are able to pass this $3 trillion package in terms of stimulus. So there's a bunch of risks on the horizon as well. We have a little bit of a resurgence into the virus cases as well. But, I think once we kind of go through these earnings and we start to get into the fall, when we start to stabilize a little bit on the inflation front as well, I think we're probably going to get a little bit better signals from the market. So I would not, fully panic here. I would just kind of, wait, digest, see, keep an eye on this kind of indicators, and, look at the dollar, look at Bitcoin, look at yields, and just kind of try to create a framework going forward. So that's why we're here as well on Early Wave Cafe. So I want to thank you guys for watching. And, go ahead and visit us on the Pro Room. I mean, we're open 24/7 there. A bunch of stuff happening, from cryptos to alts to, oil and macro and all these trades. So you can take a 7-day free trial. There's no card required. Here is what we're kind of offering into the service. And there is also a free course if you wanted to go ahead and learn about Elliott Wave. So, guys, with that, I'll leave it. And I'll see you again next week for Bitcoin and Ethereum technical analysis. Again, don't forget to subscribe and like. I appreciate you all being here, and I'll see you soon. Bye-bye.